Hey folks, welcome back to the channel. You've probably noticed the stock market has been pretty choppy recently. The S&P 500 fell about 10%. But don't worry, because a falling stock market also creates opportunities. Personally, I'm pretty eager to take advantage of this market turmoil. For example, when I sold a put option for BlackRock back in October when the stock market was doing pretty well, I only received $259 in premiums. But if I were to sell that same option today with the same strike price and everything, I would receive over $1,500 in premiums. Now, nothing has changed about BlackRock, the company, or what it does, or how much money it makes, but the valuation is now cheaper. And this change affects the derivatives market, unlocking value that wasn't there before. And that's what I'm so excited to talk about in today's video. Let's start by looking at market volatility. 10% corrections aren't rare. It happens roughly every 1 to 2 years. The question is what to do when it happens. The short answer for most people is simply to stay invested, to continue investing or buy the dip, as they say. And here's why. The VIX is a volatility index that measures how choppy the stock market will likely be. And it tends to move in the opposite direction as the stock market itself. And it's sometimes called the fear index. As you can imagine, the VIX has been increasing a lot recently, and just last week it hit 33. No one can predict the future, but we can make some educated guesses based on previous patterns. And historically speaking, when the VIX gets to this range, the stock market usually gives you a very high return over the next 500 trading days. So if you have a long-term mindset, then the VIX is saying this is the time to buy, not sell. This doesn't indicate a market bottom or anything, but it does show that buying stocks now will likely produce higher than average returns over the next couple of years. And this information alone should be enough to convince a long-term investor to stay the course. But of course, there's more to it than that. The truth is, not all market corrections are the same. It's important to also realize which sectors are leading the downturn. In 2020, for example, the general stock market index fell about 30%, but the energy sector fell twice as hard due to unsustainably low oil prices. It was a great opportunity to buy those decimated energy stocks because when the stock market eventually turns bullish again, the sector that underperformed on the way down will likely outperform on the way up. And that's why in 2020, I picked up 500 shares of Canadian Natural at about $15 each. But now in 2022, each share is worth $65. So I want to identify those disproportionately beaten down stocks so I can get more of a gain when the market eventually goes back up. Now the stock market is looking a bit dicey again, but in today's case, it's not the energy stocks that's leading the pack. It's actually growth stocks like technology companies. You have PayPal and Etsy down 50% from their highs. Same thing with Netflix. It recently fell precipitously after releasing a lower than expected growth forecast. Retail giant Alibaba makes a ton of money, but it's down 64%. And these are all profitable and innovative companies that are expected to increase their sales and earnings over time. I don't know if this is the bottom of the market, but I do know that these companies are at a heavy discount compared to where they were trading at just a few months ago. And it's certainly worthwhile to pay attention to this diverging trend between growth stocks and the overall stock market, because there's potentially a lot of money to be made once things turn around, and that gap is going to close. I can't give any specific advice on what you should do for your portfolio, but here's what I'm personally doing in this choppy environment. The first thing I'm doing is creating a list of all the stocks that I would like to buy at a discount. Most of these are growth stocks, but I do have stocks in other sectors such as BlackRock, which is a financial company, but it's starting to look kind of cheap right now. In general, you have this line here, which represents a stock's intrinsic value. It's not explicitly shown or visible, but it's always there. This more volatile line here represents the actual price of the stock on a day-to-day basis, which almost never trades at its intrinsic value. A stock trades at a discount when its price is below the intrinsic value, and right now a lot of stocks are doing this. The second thing I'm doing is selling put options on these stocks that have fallen pretty hard. These stocks are already discounted today, and by selling puts against them, I'm guaranteed to pay even less for them if they get assigned. This is like going to the store when everything is marked down, but then getting another discount on the item you buy in addition to the store discount. So here's a real trade I made last week so you can get a better idea of what I'm doing. Block is a payment processing company. It used to be called Square, and it has been following a lot lately. So I have sold a put option against it. For my expiration, I chose February 11th, which is just 2 weeks away. I want to keep this duration short to reduce the risk of uncertainty in the future. For my strike price, I chose 80 because if the current trend were to continue, like if I draw a line here, it would fall to about $86 on expiration. And I want to be a bit more conservative with my options, so I chose a slightly lower strike, which is why I went with 80. And for selling this option, I made $69 in premiums. So all that means is if block stays above $80 before February 11th, which has a 94% chance of happening, then nothing will happen to my option. It would just expire worthless. And then I would write another put option at an even lower strike price. And if block ends up being below $80, which is only a 6% chance, then I will gladly purchase the shares. Why is it a good stock to buy at $80? Because the valuation would be unsustainably cheap. The stock has already come down to 2.7 times sales, which is already a steal compared to its 5-year average, which puts it in line with the S&P 500 index. This is what I mentioned earlier. Multiple contractions produce lower stock prices, but it has nothing to do with the underlying business. It's just that investors are willing to pay less for future profits. Before, people were willing to buy the stock at 10 times sales, and now it's just 2.7. And this is at the current price of the stock. If block were to fall to $80 per share, the price to sales ratio would drop to just 2 times, which would be insanely cheap. So after selling the put, here's what I'm left with. I either just make $69 and that's it, no strings attached, or I make $69 plus I buy a fast-growing tech company at a really cheap stock price and then wait a couple years for the stock market to bounce back and probably make a killer profit. Either way, I can't really see a downside, unless, of course, the company fails. That could happen, but it's not very likely, especially when the company is profitable. And even for a more established company, we can do this for BlackRock as well. So I'll explain a little bit more in detail what happened before and why the premium is so much higher now. When I sold my previous put option on BlackRock, the stock was trading at $900 per share, and I figured its intrinsic value was somewhere around $730, so I chose a similar strike price. I earned $259 in premiums, and on December 17th, it expired worthless, which was the most likely outcome at a 95% chance. So this is how I make most of my options income every month. I sell far out of the money puts and I collect the premiums. If you're wondering how I came up with $733 as the fair value for BlackRock, you can check out my previous video where I share my detailed analysis on BlackRock and demonstrate how to sell a put option in Interactive Brokers. Today, BlackRock is trading at $800 per share, so it's $100 less. Let's say I choose an expiration date that's 1.5 months away and use the exact same strike price of $740. One reason the premium is $1,500 is because it is more likely for BlackRock to fall from $800 to $740 than from $900 to $740. The other reason is because implied volatility is higher, which causes option premiums to increase. This is one of the ways to take advantage of stock market volatility, is to become an option seller. Here is the implied volatility for Netflix over a 1-year period. This is from Alpha Query. When you sell an option when IV is high, you can actually make money even if the price of the underlying doesn't move. That's because when IV eventually comes back down, it'll lower the option's price, so you can make money from that shrinking extrinsic value. And the last thing I want to implement is a very bullish strategy called a risk reversal. I'll talk more about this in a future video, but it's basically a high risk, high reward option strategy if you strongly believe a stock is about to move higher. This is why I'm so excited about this uncertain market. I don't know if the worst is over or if stocks will continue to fall, but one of the most important skills worth practicing is learning to be comfortable being in uncertain situations. And I think options can be a powerful tool to hedge against market uncertainty because the more volatile the market becomes, the more income you can earn from trading options. So I'm really excited for the weeks ahead. I'm nibbling at stocks on the way down to lower my cost basis. I recently picked up a little bit more of Apple stock before the earnings report because they have a tendency to beat expectations and the stock generally pops when that happens. If the stock market moves higher from here, I will be making more unrealized gains, so that's good. If the stock market moves sideways, I can continue to earn option premiums, and if the stock market falls further, I'll be picking up certain stocks at heavily discounted prices and continue to sell options at even more inflated premiums because volatility will be even higher if stocks fall further. Let's see how things play out in the next month. I will upload a new video at the end of February to update everyone on what happened. If current market conditions persist, I expect to make a record amount of premiums, probably over $2,000, so that would be pretty exciting. I often post my live trades on Twitter, so if you want to follow along, you can certainly do that. Otherwise, let's see how things play out. And it looks like at least one of my sold puts is about to expire in the money. Lightspeed is reporting its latest earnings in just a few days, and it's a little nerve-wracking, but it's going to be very interesting to see what happens to my position. Anyway, thanks a lot for watching. Remember to manage your risk properly in volatile markets, and happy investing!